Tariffs are pushing the US and China to the edge of disaster. US tariffs on China hit a shocking 145%, but it's not just trade. Trust between nations is collapsing. The trade war reignited with ferocity in April 2025, when US tariffs on Chinese imports surged to a staggering 125%, layering President Trump's new 50% tariff on top of existing levies. Imagine a fortress of taxes so impenetrable it chokes off entire trade routes across the Pacific. China didn't blink. Within hours, it retaliated by raising tariffs on US goods from 34% to 84%, a gut punch to American exporters, from Midwest soybean farmers to Silicon Valley tech giants. This isn't a polite exchange of economic jabs, it's a full-on brawl. On April 9th, Trump briefly suspended tariffs on other US trading partners for 90 days, sparking a fleeting stock market rally. But this was a sleight of hand. He then escalated tariffs on China to 145%, turning the trade war into a bonfire that threatens to consume both economies. Why this aggressive escalation? For the US, it's about slashing the trade deficit and reviving domestic manufacturing. The US imported $438 billion in goods from China in 2024, while exporting only $143 billion, per the US Trade Representative. This imbalance is Trump's rallying cry, a symbol of American jobs lost to globalization. But tariffs are a blunt weapon. Higher tariffs inflate prices for American consumers, hiking costs for everything from iPhones to sneakers as companies pass on the burden. The Peterson Institute estimates that Trump's earlier tariffs added $1,200 annually to U.S. household expenses. For China, the 84% tariffs are about self-preservation, shielding its economy from what it sees as U.S. bullying. Chinese tariffs devastate U.S. agricultural exports, like soybeans, which plummeted 76% in value from 2018 to 2023 during prior trade tensions. This escalation is a game of economic brinkmanship, like two drivers speeding toward a cliff, each daring the other to swerve. Economic interdependence complicates the fight. The US and China are like conjoined twins sharing a bloodstream. Cutting ties risks mutual collapse. US firms rely on Chinese supply chains. Chinese exporters need American markets. Yet both sides are digging in. Trump's rhetoric, "We'll win the trade war," clashes with Beijing's ultimatum: lower tariffs or face consequences. Social media buzzes with analogies. It's a tariff arms race, and no one's disarming. The U.S. Chamber of Commerce warns that prolonged tariffs could shave 0.8% off U.S. GDP by 2026, while China's export-driven economy faces similar pain. Neither side can fully retreat without losing face, politically or economically, setting the stage for China's next, potentially catastrophic move. China's bond sale plan could cripple global markets. It's dumping up to $1 trillion in U.S. bonds. This isn't just revenge, it's a play to dethrone the dollar. China's response to the tariff onslaught is a financial thunderbolt, selling its $900 billion to $1.1 trillion in U.S. Treasury bonds. This isn't a mere counterpunch, it's a potential trade atomic bomb, as social media dubs it, capable of detonating chaos across U.S. financial markets. Picture China as a major stakeholder in the U.S. economy, threatening to liquidate its shares in a fit of rage. Treasury bonds are the U.S. government's IOUs, and China holds about 13% of the $7.6 trillion in foreign-owned U.S. debt as of 2024, per the U.S. Treasury Department. For decades, China snapped up these bonds to invest its trade surplus, financing U.S. deficits while safeguarding its reserves. It's like a landlord bankrolling a tenant's lavish lifestyle until the tenant starts a fight. Now, that fight is here. Reports from April 2025 reveal China's central bank is curbing dollar purchases and offloading portions of its bond stockpile. This isn't impulsive. Trump's 145% tariffs signal an existential threat, pushing Beijing to flex its financial muscle. China's goal is to reduce its dependence on the US dollar, diversifying into assets like the digital yuan, gold, or euro-denominated bonds. Think of China as a captain steering its economic ship away from a stormy U.S. harbor toward calmer waters. Social media leaks suggest Chinese banks have been ordered to prepare for dollar exits, a sign of strategic intent. What happens if China pulls the trigger? A large-scale bond sale would spike U.S. interest rates, as flooding the market with bonds drives prices down and yields up. The 10-year Treasury yield, at 4.2% in March 2025, could leap to 6% or beyond, per Bloomberg projections. This makes borrowing pricier for the U.S. government, which faces $33 trillion in debt. The Congressional Budget Office estimates a 1% yield hike adds $250 billion annually to debt servicing costs. The dollar could lose 5 to 10% of its value, stoking inflation as imported goods cost more. The Federal Reserve warns that 5% inflation could erode consumer spending by $500 billion annually. U.S. stock markets could crater, evoking the 2008 financial crisis but with global stakes. Social media screams, China's bond dump could send us into a 2026 recession. But there's a twist. China risks self-inflicted wounds. Selling bonds devalues its remaining holdings and dollar-based reserves, potentially costing 10 to 15% of its portfolio's value, per Goldman Sachs. It's like torching your own savings to burn your rival's house. Yet, Beijing might stomach this loss to cripple the U.S. financially, especially if trade ties unravel. This isn't a bluff but a calculated escalation, like a general deploying a risky but devastating weapon. Experts debate whether China would sell all $1 trillion at once, unlikely due to mutual damage, or opt for a gradual sell-off to signal resolve. Either way, the threat alone is a financial guillotine hovering over Wall Street. China's bond threat is torching U.S. markets. The S&P 500 crashed 8% in a week. But it's not just stocks. Your mortgage and groceries are next. The rumor of China's bond sale has already ignited a firestorm. U.S. stock markets plummeted in April 2025, with the S&P 500 diving 16% in a single week, per Reuters. Investors, rattled by rising bond yields, are dumping stocks and bonds in a frantic exodus. Imagine a crowded theater where one shout of fire sparks a stampede. The 10-year Treasury yield hit 4.8%, a 2025 peak, pushing mortgage rates towards 7%. CNBC reports that a 1% mortgage rate increase could cut U.S. home sales by 10%, hammering construction, retail, and jobs. The housing market, a pillar of U.S. growth, teeters on the edge. The domino effect is brutal. Higher yields raise borrowing costs, squeezing corporate profits. The National Association of Manufacturers warns that a 1% yield hike could slash industrial output by $50 billion. Inflation, at 3.5% in Q1 2025, could climb to 5%, eroding consumer wallets. The dollar's 3% drop against the yuan in April jacks up import costs, from electronics to clothing. Wall Street is in full panic mode, with social media amplifying the dread. Trump's tariffs are boomeranging. China's bond threat will bury us. Even bond funds, traditional safe havens, are selling, fearing a value collapse if China unloads. Trump's mixed messaging fuels the chaos. He declares, "We're winning on tariffs," yet hints at talks. "I'm waiting for China's call." This inconsistency is like a captain shouting conflicting orders during a storm. The U.S. bond market, once the bedrock of global finance, is now a war zone. The Guardian reports a dramatic sell-off, with yields spiking as investors flee. Forbes warns, China's bond sale could derail the U.S. rally. If China sells even $200 billion in bonds gradually, Morgan Stanley predicts a 0.5% GDP hit by 2026. The chain reaction could spread. Rising yields might choke small businesses, which employ 47% of U.S. workers, per the Small Business Administration. China isn't unscathed. Its Shanghai Composite fell 5% in April, as exporters brace for U.S. tariff pain. Both nations are trapped in a lose-lose spiral, like two boxers pummeling each other into exhaustion. The question looms, can markets endure this onslaught, or are we hurtling toward a 2008-style meltdown? The answer hinges on whether this financial tempest is a passing storm or the prelude to a Category 5 hurricane. This trade war could plunge the world into recession. It might cost 200 million global jobs, but Asia could rise as the U.S. stumbles. This U.S.-China clash isn't a two-player game. It's a global minefield. A full-scale bond sale could spark a worldwide recession, reminiscent of the 1930s Great Depression, when protectionist tariffs strangled trade. The IMF forecasts 3.2% global growth for 2025, but a sustained trade war could lop off 1%, devastating emerging markets. Japan, $1.2 trillion in US bonds, and Europe, $1 trillion, brace for a market shock. Rising US yields could siphon capital from Asia and Latin America, starving their economies. Picture a financial vortex, sucking resources from every corner of the globe. Global players are forced to choose sides or hedge. Russia and India, aligning with China, may trim dollar holdings, challenging US financial dominance. US allies like the UK face a bind. Loyalty to Washington risks exposure to a bond market rout. Social media sounds the alarm. If China sells, global inflation spikes and growth tanks. The World Bank estimates a 10% trade drop could eliminate 200 million jobs worldwide, with the US and China hit hardest. Other markets could seize opportunities as Asian exchanges like Hong Kong gain if investor confidence in the US wanes. The deeper shift? China's push to dethrone the dollar. Its digital yuan and local currency trade pacts with ASEAN nations signal a long-term pivot. This could erode the dollar's 40% share of global transactions per the Bank for International Settlements. The US-China trade war could redraw the financial map, with Asia ascending as the US falters. Yet, the immediate risk is chaos. A 1% US yield spike could disrupt $10 trillion in global bond markets, per JP Morgan, altering capital flows and investment. Can diplomacy avert disaster? Trump's waiting for a call, and China's lower tariffs first demands hint at a possible deal. But political pressures, Trump's 2026 re-election push, China's need to project strength, make compromise elusive. A gradual bond sale might force negotiations, acting as a warning shot rather than a nuke. Still, missteps loom, like two warships navigating a foggy strait. Social media warns of a 2026 crisis, evoking 2008's Lehman collapse. The world economy hangs in a delicate balance, with every move by Washington or Beijing rippling across continents. China's slamming the brakes on Boeing's lifeline. Billions in jets are being shipped back to the US. But this isn't just about planes, it's a dagger to America's industrial heart. The trade war has struck Boeing, America's largest manufacturing exporter, with devastating precision. In April 2025, China ordered its airlines to halt Boeing jet deliveries, a direct retaliation to Trump's 145% tariffs on Chinese goods, as confirmed by Boeing CEO Kelly Ortberg in a Reuters report. Picture a brand new 737 MAX, valued at $55 million, painted in Xiamen Airlines livery, flying 5,000 miles back to Seattle because China's 125% tariffs inflate its cost beyond reach. For a single jet, tariffs add over $68 million, rendering purchases untenable for Chinese carriers like China Southern, which plan to take dozens of MAX jets. Beijing's ban extends to US aircraft parts, choking Boeing's supply chain and threatening its fragile recovery from prior 737 MAX crises. This isn't a minor setback. It's a trade war torpedo aimed at a US industrial giant. China, projected to drive 20% of global aircraft demand over the next 2 decades, was set to buy 179 Boeing jets by 2027, a multi-billion-dollar lifeline. The halt disrupts this pipeline, with analysts like Douglas Harned warning of larger-than-expected financial risks. Boeing's shares plummeted nearly 3% on April 21, 2025, as Wall Street recoiled from the tariff chaos. Social media erupted. Trump's tariffs are grounding Boeing's China dreams. The pain is compounded by history. Boeing's China market has been shaky since 2019, with only 28 orders from 2019 to 2024, mostly freighters, due to earlier trade tensions and safety concerns. Boeing's options are grim. Ortberg claims the company can redirect jets to markets like India, where demand is surging, but reconfiguring planes for new buyers is costly and slow. The ripple effects threaten 140,000 Boeing jobs and thousands more in its US supply chain, per the Aerospace Industries Association. For China, the move is a high-stakes chess play, sacrificing aviation growth to pressure Trump. China's domestic COMAC C919 jet can't yet match Boeing's scale, and Airbus faces production constraints. Both sides bleed in this standoff, like duelists wounding each other with every strike. Chinese airlines face delays in fleet expansion, critical for their post-COVID recovery, while Boeing's cash flow stalls, potentially delaying innovation like next-generation aircraft. The broader stakes are stark. Boeing's woes reflect the trade war's toll on U.S. manufacturing, which accounts for 11% of GDP. If China sustains its ban, it could shave $10 billion off Boeing's 2026 revenue, per Morgan Stanley estimates, with knock-on effects for suppliers and communities in states like Washington. Yet, China risks isolating itself from Western aviation tech, a long-term liability. This is a microcosm of the trade war's lose-lose dynamic, where strategic wins come at brutal costs. The skies over the Pacific are darkening, and Boeing's grounded jets signal turbulence for the U.S. economy. Trump's tariffs are hitting your medicine cabinet hard. Drug prices could soar and shortages loom. But it's not just your wallet. Your health is on the line. Trump's trade war has dragged prescription drugs, once shielded from tariffs, into the crossfire, turning pharmacies into battlegrounds. On April 9, 2025, Trump imposed tariffs on pharmaceutical imports, targeting raw ingredients from China and European drug manufacturing, as reported by Reuters. Picture a patient staring at an empty pharmacy shelf, unable to afford generics like antibiotics because tariffs of 25% or higher inflate costs or trigger shortages. Generics, 90% of U.S. prescriptions, rely heavily on China and India for active ingredients in drugs like ibuprofen and metformin. Industry leaders like Eli Lilly and Johnson & Johnson warn that tariffs could disrupt supply chains, risking shortages that could delay treatments for millions. Trump's rationale is twofold: end U.S. reliance on foreign drug supply chains and counter Europe's lower drug prices, which he claims burden American consumers. A 2024 study showed Europeans pay 50% less for some generics due to price controls. But tariffs could backfire, hiking costs for U.S. patients. Johnson & Johnson faces a $400 million tariff hit in 2025, largely on medical devices, while Eli Lilly's CEO, David Ricks, told Reuters that tariffs will harm patients by squeezing R&D budgets. Social media laments, tariffs on drugs? We're paying the price for Trump's war. China's 125% tariffs on U.S. goods, including pharmaceuticals, hit firms like AstraZeneca, which manufacture drugs in the U.S. for China's market, creating a vicious cycle of retaliation. This is a healthcare gamble, like rolling dice with patients' lives. The administration's Section 232 investigation, launched in April 2025, probes pharmaceutical imports as a national security threat, signaling more tariffs ahead. Trump's team points to $27 billion in new U.S. drug manufacturing investments by firms like Eli Lilly as proof tariffs work. But experts like Scott Gottlieb, former FDA commissioner, argue that shifting production takes years, and shortages could hit first, especially for low-margin generics. The Kaiser Family Foundation estimates a 20% price hike on generics could cost U.S. consumers $10 billion annually. China's drug market faces its own pain, as U.S. tariffs disrupt its access to advanced biologics, critical for diseases like cancer. The human toll is stark. Shortages could delay treatments for chronic conditions, like diabetes, affecting 37 million Americans. Hospitals, already stretched, may ration drugs, as seen during COVID-19 supply shocks. For China, tariff retaliation risks slowing its pharmaceutical sector, which relies on U.S. innovation for high-end drugs. Both nations are trapped in a lose-lose spiral, like wrestlers locked in a hold that injures both. The trade war's reach into pharmacies underscores its indiscriminate damage. Patients, not just corporations, bear the cost. Social media buzzes with fear. First Boeing, now drugs. When does this trade war end? The pharmacy counter is a new front line, where the stakes are not just economic, but deeply personal, threatening health and hope across borders. The U.S.-China trade war, driven by towering tariffs and a $1 trillion bond sale threat, is a seismic struggle for economic supremacy. Like two gladiators locked in mortal combat, Both risk dragging the world into their arena. The stakes are colossal: soaring interest rates, collapsing markets, and a looming global recession. Trump's tariff gamble and China's financial counterstrike have turned bonds, once symbols of trust, into weapons. Without compromise, a lose-lose catastrophe awaits. What's next? A bond sale, even phased, could destabilize the US, but China won't escape the fallout. The world watches, holding its breath. Share your predictions below, like this video, and subscribe for updates on this unfolding saga. Will it end in turmoil or a handshake? The future of global finance rests on a knife's edge.